Welcome, everybody, to our 2026 Investment Outlook. Today, I'm pleased to be joined by three senior members of the investment team: Stephen Violin, Managing Director of Investment Management, Ryan McQuilkin, Managing Director of Fixed Income, and William Yang, Principal and International Equity PM. A few housekeeping things before we start. You've already read the disclosures, so thank you for that. If you want to ask a question, you need to ask it in the Q&A button at the bottom of your Zoom screen. These questions will only be seen by the moderators, not by other attendees. And the chat in the Zoom is disabled, so please use the Q&A button. At the end of the webinar, there's a survey. We would love it if you would fill that out. It helps us to provide content that works for you. I should note that the survey is anonymous. So if you would like a member of your F.L.Putnam team to reach out to you, you do need to identify yourself in one of the text boxes. Otherwise, we won't know who you are. And this is mostly a fireside chat format, although we do have a few slides. In general, it's going to be a conversation. So if we look at the next slide, you can see our team. As I mentioned, I'm Ellen Hazen, Chief Market Strategist. And we also have Stephen Violin, Ryan McQuilkin, and William Yang. The agenda for today is first a quick recap of 2025 and outlook for 2026 by asset class. We'll do that with an economic overview as well as U.S. equities, international equities, and fixed income. After that, we'll turn to discussion of some common questions that we've been getting from clients. We will also look at your questions that you have and try to answer those as well. This whole webinar should be a little under an hour. So with that, let's get started. I'm going to start with an economic overview. Looking back at 2025, the economy was surprisingly strong, especially considering how disruptive market participants initially expected the tariffs to be. You can see that on Liberation Day, which was in April when these lines went straight down, GDP estimates plummeted, but only stayed low for a few weeks and then immediately started climbing. What this graph shows is GDP estimates for 2025 and 2026 and how those estimates evolved over time. And so before Liberation Day, economists thought the economy would grow 2.2% in each of last year and this year. And then when Liberation Day happened, they cut their forecast quite dramatically to 1.4%. But then you can see that by the end of December, economists had brought their estimates back up to 2%, which is where they stand now, roughly. Now, as we look into 2026, we think that's going to be another growth year. Now, why is 2026 going to be another good economic growth year? Well, first of all, both fiscal and monetary policy are supportive for economic growth in 2026. On the fiscal side, we have the One Big Beautiful Bill Act, which is estimated to add somewhere between 0.4 and 1.0% to GDP because of no taxes on tips and overtime, tax refunds, which will show up in the first quarter, and also bonus depreciation, which allows companies to increase profits by writing off expenses more quickly. So that's the fiscal stimulation. We also have monetary stimulation. The Federal Reserve lowered interest rates by 1 3/4 points over the last year and a half. The current Fed funds rate at 3.5 to 3 3/4 is fairly low, and with inflation at about 2.8%, you can see that real interest rates, so in other words, the overnight rate minus the inflation rate, is only 75 basis points or 0.75%, maybe 1%, something like that. So real rates are quite low, and that's very stimulative. The market currently expects another 2 cuts in 2026. We will see whether that happens, but that would bring the Fed funds rate down to 3% by year end. And then on top of the fiscal and monetary policy, spending on artificial intelligence of just the largest spenders is material, nearly $500 billion this year. To put that in context, that's nearly a third of the annual deficit. It's about 1.5% of GDP. It's a pretty big number. Now, everything is not rosy. There are a couple yellow flags. A couple of the major indicators that we watch are not ideal. First of all, the labor market has been weakening since the summer of 2025. You can see that the average new monthly job creation, which is what this bar chart shows, was 168,000 in 2024, 168,000 new jobs per month, only 83,000 in the first half of last year, and only 11,000 in the second half of last year. So clearly the labor market is weakening. Moreover, inflation has remained above 2% since the pandemic. The most recent reading of 2.7% is well above the Federal Reserve's 2% target. So in our view, this precludes significant further monetary easing unless inflation declines. So we'll get a little bit of easing, but unless inflation comes down, we can't get a lot of easing. So adding it all up, while we see positives for the US economy in 2026 due to fiscal stimulus, monetary stimulus, and artificial intelligence spending, the labor market's clearly weakening and inflation remains above the 2% target. Now, internationally, in many countries, we see fiscal stimulus as well, as you'll hear about from William. And so broadly, we see supportive backdrops across many risk asset classes globally. The key risks to this outlook across all these regions in general are, of course, geopolitical tensions and high starting valuations in many cases. With that, I'd like to ask my colleague Stephen to tell us about his outlook for U.S. equities. Stephen, what are you thinking?
Well, thanks, Ellen. As you described, we are expecting a relatively benign macro environment in 2026, with monetary and fiscal policy being relaxed. I'd like to highlight a couple of additional trends that we expect will be key drivers of corporate profits in 2026. After all, we do expect that stocks will gradually follow corporate profits over time. And first, Ellen mentioned AI investments. Artificial intelligence capabilities have been a major contributor to the S&P 500 earnings growth trend in recent years, and we expect that's going to continue in 2026. As you can see in this chart, capital expenditures amongst the four large hyperscalers, the four companies building out infrastructure to support artificial intelligence capability, they are listed here: Amazon, Alphabet, Meta, and Microsoft. Those capital expenditures are expected to grow by 33% to $465 billion in 2026, following growth of 61% in 2025, 55% in 2024. The scale of these investments is just incredible. It's more comparable to a massive government stimulus program than anything ever undertaken by the private sector. The potential productivity enhancement of this technology remains promising, and the impact of these technology investments actually still seems underestimated in many parts of the market. So we expect it will continue to have impact in earnings, not just in the technology sector, but in other areas as well, as software is developed to continue to take advantage of these infrastructure investments over time. On the next slide, you can see earnings growth outside of the technology and communication sectors that have been benefiting from all this spending on artificial intelligence infrastructure. Bloomberg estimates overall earnings growth for the S&P 500 in 2026 at 13%, and that's an impressive number just at an absolute level, but it also represents some acceleration from the 11.7% growth rate that's estimated for 2025. This acceleration of earnings growth is also broad. It's not just reflected in the technology and communication sectors that have been driving earnings growth in the S&P 500 in recent years. That breadth is reflected, as you can see, in green in each of the sectors outside the telecommunications and technology sectors, not just in 2026, but 2027, which of course the market will begin to focus on as we move through the calendar year of 2026. It's really this combination of continued investment in AI infrastructure and this broadening earnings acceleration that could prove particularly powerful for U.S. equity markets, especially given this is likely to be occurring within an economic backdrop, as Ellen described, of easing fiscal and monetary constraint. The result is we're cautiously optimistic on U.S. equity markets, but we're also optimistic overseas and international markets. My colleague William Yang manages the firm's international stock strategy. He'll provide an update on our outlook there.
Thank you, Stephen. Yes, so as Stephen mentioned, the U.S. stock market had another very strong year of performance in 2025. Now I'd like to turn our attention to the international equity market. So if you look at this table here, slide here, you can see that international equity, which is showing on the yellow line, it is significantly outperformed the US stock market, which is showing on the blue line by almost 15%. So a weak US dollars definitely provide a very important tailwind to the strong relative performance of the international market. As we can see from this chart, the green line, that's the US dollars performance for the last year. The US dollars actually depreciated about 9% last year. So that is helping to boost international returns when translate back to the US dollars term. But we have to point out, currency is not the only part of the story for the international outperformance. The outperformance was also driven by a combination of the attractive valuation and improving earnings outlook, and also the global capital reallocation trend. And it's also worth noting that international's outperformance was spread across the regions and sectors. So as you can see from the chart, on an equal weighted basis, the equal weight international equity retained 28%, which is shown on this brown line, and outperformed the equal weight S&P 500, which is on red line, by 17%. So it is showing international, the growth and the rally is very broad, and it's a very healthy and a more durable momentum across the international market. And now if we can move to the next slide, when we look ahead to 2026, the earning outlook for international equity remain very supportive. As we can see from this slide, according to Bloomberg estimate, international equity are expected to grow about 12.5% earning growth in 2026 and also above 11% in 2027, which are very impressive because it's almost double its historical earnings growth rate. And it's also important to note that this earnings growth was coming from multiple regions, such like Europe, Japan, and selective emerging market. Those markets are all showing strong earnings growth ahead. And when we combine this improving earnings backdrop with a still attractive valuation, international market is still trading at about 32% discount compared to US. So this will provide a very comparing opportunity for the international when we head to the 2026. And now with that, I'd like to hand over to my colleague Ryan to discuss fixed income. Ryan.
All right, thank you, William. So in 2025, there were several risks that really could have disrupted the bond market. Inflation was persistent, government debt and deficits were still a concern. There was definitely some economic disruption from tariffs. We also had a couple high-profile bankruptcies in September. First Brands and Tricolor Holdings were the two companies. And we also had a government shutdown. So any of these risks could have caused interest rates to rise or credit spreads to widen, both of which hurt bond returns. But ultimately, these risks weren't enough to derail economic momentum. And at the end of 2025, rates were actually lower and credit spreads were actually tighter compared to where they started the year. So this combination of lower rates and tighter spreads led intermediate duration fixed income to a 6.97% return in 2025, which was its highest yearly return since 2007. And so bond markets and especially credit markets are starting off 2026 in pretty good shape because credit spreads are tight, which means low levels of credit stress. And overall, there are healthy conditions for borrowing as evidenced by bond issuance trends. So this was a notable occurrence last year, was just the sheer amount of bonds that were issued by companies and municipalities. And we have the chart here. So this graph shows the last 6 years of total issuance from 2020 all the way through 2025. And you can see the amount of high yield corporate bonds on the left. You can see municipal bonds in the center and investment grade corporate bonds on the right hand side. So 610 billion was issued in the municipal bond market, which is a record. That's the middle section. In investment grade corporate bonds, the section to the right, almost 1.6 trillion was issued, which was the second highest ever. So overall, that's a good sign for companies and the economy because these proceeds can now be used to invest in profitable projects. So that gives us, it's a big positive sign for the year ahead. And of course, as others have mentioned, a big theme was AI investments, and that was a major part of the issuance story last year. Um, Already this year, companies like Broadcom, Jefferies, T-Mobile have raised money in new issue markets successfully. Um, and so 2026, the existing credit environment leads us to a positive view on corporate and municipal bonds, but we are recommending diversification into other fixed income areas, such as securitized bonds. We like emerging market debt. We also recommend building portfolios with relatively short 3 to 4 year average durations to minimize volatility. In case we get a spike in interest rates, we've certainly seen a bit of that interest rate volatility show up already. And then as part of our outlook, we still think it makes sense to have inflation protection in portfolios. Ellen showed that spoke to inflation earlier. And for that, we favor short maturity tips to hedge against inflation. In regards to that inflation theme, this sort of shows what Ellen was talking about earlier. You can see the different measures of inflation here in blue and gold. You can see it has subsided quite a bit since its peak in 2022, but progress has stalled down by 2.5% to 3%, which is still above the Fed's 2% target in red. So ultimately, if the U.S. economy accelerates in 2026, which we think is likely, then inflation pressures may increase, and having those inflation hedges in portfolios will be important. So that concludes our discussion of the 2026 outlooks. So I will send it back to Ellen.
Thanks, everybody. Now that we've laid out our outlook for fixed income, domestic, international equities, we thought we'd discuss some common client questions that we've been getting. The first one is, what are the biggest risks to your outlook? So, Stephen, why don't we start with you? What are the biggest risks to your outlook for domestic equities?
Well, there's a number of them, but certainly the single biggest risk in US equity markets is the AI investment cycle. Years of market leadership have resulted in a market that's unusually concentrated and expensive. AI beneficiaries now represent about half of the market cap of the S&P 500, and the combination of this concentration and lofty valuations makes the overall market unusually vulnerable to any disappointments in this one area. Now, disappointments could stem from a number of sources. It could be physical constraints on data center construction, such as the availability of networking equipment, power, or even the willingness of capital markets to provide financing. A second risk is the macroeconomic environment, which Ellen laid out. It did slow noticeably in 2025, and while we expect the economy to reaccelerate, further deterioration in the labor market could trigger a self-reinforcing downturn in consumer spending. The soft labor market could even lead to a backlash against AI, resulting in these two primary risks becoming intertwined. There are also numerous political and geopolitical risks associated with the current environment that have implications for inflation, interest rates, and equity valuations, although we expect that looming midterms may reduce the likelihood of a repeat of the policy disruption caused by the tariffs that were rolled out last spring. Lastly, I think it's important to note that where valuations stand currently, they are elevated, and while markets can remain cheap or expensive for extended periods of time, high valuations increase the downside in the event of a negative surprise. So the bottom line here is that while we remain optimistic, given the facts on the ground at the moment, risks abound in U.S. equity markets. International markets are a little bit of a different story given the appealing valuations, and I'll let William expand on that point.
Sure, Stephen. So, as Stephen said, when we evaluate the international equity, the biggest risk is not about the stretched valuation or excessive sentiment on AI or any other topics. Instead, I want to focus on a couple of things such as geopolitical risk, global economic growth, and the possible Japan carry trade meltdown risk. So let's start with the geopolitical risk. So as we head into the 2026, we already see a lot of geopolitical risk coming. So for example, invasion of Venezuela and uncertainty on the Greenland and also the Iran protest, and also the ongoing war between Russia and Ukraine, and also potential China invade Taiwan. So all those escalating global geopolitical risk tension could have a very negative impact on the international market, at least in the short term, because international could have a big exposure to the increasing uncertainty, disrupting trade flows, and the tightening financial conditions. Those all could weigh on the international market. And another risk is a slowing global economic growth, really driven by the policy missteps and weaker global trade activities. So just to be clear here, we are not forecasting a global recession here, but many international economies are operating with less fiscal and monetary flexibility than the US have. So that means any tiny policy misstep tend to have a larger impact to the international market. And in the meantime, international economies are far more trade dependent. And in many developed and in emerging markets, export account for about 30 to 60% of GDP versus about 10 to 12% in the US. So as a result, trade disruptions from tariff or supply chain shift or weakened global demand could all have a negative impact on the international market. And the third, the last, that might be the one of the most underappreciated risk, is the potential for another meltdown of Japan carry trade. So a quick reminder of the definition of the Japan carry trade, which means investor can borrow very cheap Japanese yen at a very low interest rate, and then invest that to the high-yielding asset outside of Japan. It works very well when interest rates in Japan remain low and Japanese yuan remain stable. But however, the setup looked very fragile in 2026. The Bank of Japan just raised the interest rate to 0.75 last December, and we expect to see another 1 or 2 interest rate hike in 2026. And in the meantime, the yen remain heavily shorted on the currency market and could potentially appreciate in 2026. And as a matter of fact, as of yesterday, after the announcement of the possible Greenland dispute with EU, Japanese yen also sold, Japanese bond also sold off, and the 30 years bond yield just reached a new high to 3.7%, which could form another perfect storm for the meltdown of Japanese carry trade if both interest rate and Japanese yuan go up. And as we remember in 2024, August 2024, the quick meltdown of Japanese carry trade could bring down Japan about like double-digit decline for one day, and also could have a big impact for the whole global equity market. So that could be another potential risk for the international and the global market. And with that, I would also want to turn to Ryan to share his perspective on the key risk and opportunity on the fixed income side.
Sure, thank you. So there are a few risks in fixed income that are worth watching. So number one, I'd say an overall a loss of bond market confidence that leads to instability in interest rates. So essentially a bond market rebellion or a return of the bond vigilantes could spike interest rates. So this was a term coined back in the 1980s to describe how investors can punish governments by selling their bonds when there is the perception of excessive spending or risky policies. So those pressures this time could come from renewed concerns about the path of the U.S. budget deficit. It could come from an inflation spike. It could also come from the perception that the Federal Reserve is no longer independent, but rather a political tool. So any of these could lead to a spike in interest rates that would definitely undermine markets. A second risk is simply valuation. We monitor corporate bond spreads, which is essentially how much additional yield you are getting by investing in a corporate bond rather than a similar maturity U.S. Treasury. In investment grade corporate bond markets right now, that spread is about 75 basis points of additional yields that you are getting, which is 0.75%. In high yield markets, that spread is around 250 basis points or 2.5%. So if you look over the last 10 years, those spreads have only been tighter about 7% of the time, meaning bond markets are much like many other markets these days in that valuations are stretched and it leaves much less room for error. So those are two risks. I'd say finally, there's also some risks related to debt-funded AI investments. Many issuers were able to borrow successfully in 2025 and receive very attractive rates. But going forward, will the bond market continue to believe in the long-term AI story and support its borrowing needs, or will it balk at some of these funding needs, which could prove to be disruptive to risk markets overall? So that's a third risk. So just to summarize, fixed income risks in 2026, bond market interest rate instability that leads to higher interest rates, overvaluation, which means there's much less room for outsized returns, and then also some risks related to the AI infrastructure build out. So those are some fixed income risks. Ellen, do you want to touch on risks you're watching at a macro level?
Sure. Thanks, Ryan. As others have already discussed, the biggest risks to the anticipated 2% GDP growth from a macro perspective could come from a weaker labor market, resurgent inflation, or the seemingly relentless attack on Fed independence. One reason the labor market has been weak is sharply lower immigration. While fewer immigrant workers means potentially higher employment for native born Americans, and at the same time, simplistically, you can think about GDP as the number of people employed times how productive each person is. And so, all else equal, with fewer people employed because of sharply lower immigration, your GDP would be lower, all else equal. Inflation is another risk. And this may depend on how much of the tariff price increases companies pass on to consumers. So most companies have not passed along cost increases from tariffs to consumers, but they might start to do that. And lower immigration could also hit inflation because it could raise wages, which again would feed through into higher costs that some companies would want to pass on to consumers. And so finally, you also have electricity prices. Those are being driven higher by AI. And so that's another thing that can increase inflation. So inflation can also reduce GDP. And then finally, a less independent central bank would presumably reduce short-term interest rates faster, but it would quite likely lead to higher, longer-term rates and a weaker US dollar, which could hurt US investments as the bond vigilantes, as Ryan pointed out, returned. So those are the key things we're watching from a macro perspective: the labor market, inflation, tariffs, and central bank independence. So now that we've talked about risks to our outlook, let's talk about another area that we're getting a lot of questions from clients about, and that is, what are the investment implications of the artificial intelligence build out? So Ryan, why don't we start with you? How is AI impacting the fixed income and credit landscape?
Right. So once again, funding for that AI build out is showing up in bond issuance. So four of the five largest bond deals of last year were issued by companies that are investing heavily in AI. Meta wins the crown for largest bond deal when they raised $30 billion in October. But other large deals came from Oracle, came from Alphabet, came from Amazon. And in bond markets, strong issuance generally implies healthy credit conditions because it shows that the buyers of those bonds have enough confidence in a company's outlook to lend it money. And then also, these investments are going to have a strong impact on economic growth in the year ahead as that money is invested into the economy. So, with that being said, the bond market has definitely started to distinguish which companies are riskier borrowers than others. So many companies like Alphabet, Amazon, Microsoft are easily funding AI investments out of existing free cash flow. The market has assigned a very, very low level of risk to those companies. On the other hand, a company like Oracle is borrowing above and beyond free cash flow to fund its investments, and the bond market has assigned a bit of a higher risk there, as reflected in wider credit spreads and a somewhat higher chance of default. Although it's worth noting that despite having a higher risk than other issuers, the nominal level of default risk assigned to a company like Oracle is still quite low, currently less than 1%, less than a 1% chance. So, but when you compare that with Microsoft, for example, which essentially has a 0% chance of default as defined by bond markets. Stephen, do you want to discuss how you were thinking about the AI impact as it pertains to U.S. equities?
Happy to. And I've already addressed AI infrastructure in particular as both a key driver and a key risk in terms of corporate earnings in 2026. But perhaps more importantly, it's possible that 2026 represents a turning point where artificial intelligence becomes more about applications being built on that infrastructure than the infrastructure spending itself. Infrastructure spending's been booming, but the actual applications that are likely to boost productivity and corporate profit margins are still in the early stages of build out and adoption. So one of the key themes that we expect to track throughout 2026 is managing AI risk as the AI infrastructure build out begins to hit some limitations, while also identifying areas where the applications built on this infrastructure could result in margin and profit growth above market expectations as they currently stand. That's a trend that could lead to really broad and durable earnings growth that compounds over time, ultimately why we invest in equities. So the implications in the US, they're complex, they're mixed, but at least from a long-term perspective, likely overall positive. I think the same is true overseas, but I'll let William dive into that area.
Sure. So as Stephen pointed out, AI is the clear, powerful growth driver in the US equity market. But the opportunity set looks quite different in the international equity market. So in the US, AI exposure is largely central on the consumer-centric platforms and the frontier model development. But outside of US, AI development is more about enabling the physical and the industrial backbone and make larger scale AI adoption possible. So first of all, international market sits deeper in the AI value chain, supplying physical components that make AI possible. For example, ASML and the Taiwan Semiconductor play a crucial role in advanced chip manufacturing. This business may not consumer facing, and then maybe a lot of consumers not even realize those companies exist, but they are the foundation for the whole global AI adoption. Secondly, international companies play an important role in global AI infrastructure build-up. AI requires enormous computer power, reliable electricity, cooling system, and power efficiency. So international companies are heavily exposed to this part of build-out. Firms like Schneider Electric and ABB benefit from the data center power management, grid upgrade, and the electrification trend. Thirdly, the direction of AI adoption in the international market different meaningfully from the US. Many international economies are structurally more industrial and export-oriented. So where the focus for the AI adoption is deploying AI at a scale across manufacturing and the industrial process. Companies like Siemens and ABB are very well positioned to benefit from this trend. So in conclusion, while AI is a very powerful global investment theme, but international exposure looks very different from the US. That difference is exactly what make international AI exposure a complement rather than substitute to the AI investment with a diversified portfolio for the client. And now, if we can, let's switch gear to discuss government policy changes, which has been the top of mind for many clients lately. We receive a number of questions about how recent policy changes in US and in international could impact the whole global market. And I will start with the international perspective and then hand over to my colleagues to cover the US side. So on the international side, we are seeing a very meaningful shift to the more expansionary government fiscal policy across the international market. Germany, as an example, is losing its very conservative fiscal discipline to invest aggressively in the infrastructure, climate, and defense. And Japan's new government is also pushing stimulus to support consumer consumption and GDP growth. And China is also signaling they will initiate more fiscal support to jumpstart their economy again. So broadly, major international economies are moving toward more aggressive fiscal policies, which should benefit cyclical sectors like bank, industrials, and consumer discretionary sectors for international market. And on the monetary side, policies are diverging from US. So the ECB is holding rate steadily, and the Bank of Japan began to normalize after a decade of ultra-easy interest rate policy, while US is moving toward the rate cut. And this divergence on the monetary policy could pressure the US dollars, make US dollars even weaker, and also it will help relative performance for international equities. And geopolitical risk, as we mentioned before, is also shift from the background risk to a more core policy drives now. And imagine we have another trade war, hiking the tariff, and disrupt the global supply chain, and increase defense spending. Those could all have a big impact on the equity market. And with that, I would like to turn to Ryan to discuss U.S. policy, government policy changes.
Right. So when it comes to government policy, the first thing on our mind as fixed income investors is the independence of the Federal Reserve, especially given the recent Department of Justice subpoena against the Fed. So we believe strongly that an independent Fed that is setting interest rates is critical for maintaining market credibility and economic stability over time. So that's kind of a concerning trend that we're watching closely, especially to the extent that it could disrupt bond market confidence or lead to even incorrect decisions when setting the Fed funds rate. I'll also just say that broadly, it's clear that this is a time when government policy is much more unpredictable and unstable. So it's leading many investors to diversify their exposure to U.S. markets. And so we're doing that too. We think that's a good idea. And so that has led us to emerging market debt as an investment, which has an attractive yield, strong fundamentals, and diversifies our U.S. dollar exposure. But Stephen, are there things on the government policy front that are shaping our equity views?
Absolutely. I'd say there's more than a few things. There's actually an incredible array of government policy changes underway with implications for equity markets. Some of the policies are likely to have very broad but potentially shorter term impact, such as the accelerated depreciation in the so-called One Big Beautiful Bill that Ellen mentioned earlier. Others are much more narrowly targeted and could have longer term implications at the sector or security levels. They're much more narrowly targeted. Examples would be things like regulatory support for private market investments and retirement plans, or stable coins within the banking system. Overall, we expect that government policy will be supportive of public market valuations in 2026, but the longer term implications are less clear. The federal deficit remains a concern. It's elevated such that rising debt levels over time could reduce the country's financial flexibility and inhibit future growth. The stability of interest rates and the dollar that both William and Ryan have mentioned highlight important supports for the U.S. equity markets as well. In the past, the U.S. system has proven remarkably adaptable, and our expectation is that that flexibility is going to be much needed in the coming years. With that being said, I'll turn this back over to Ellen to pull the various pieces of the macro backdrop.
Thanks, Stephen. So in terms of policy changes, the most important policy changes that can impact global GDP and global profit growth, which is really what stocks and bonds key off of for the most part, are the stimulative fiscal and monetary policies that are happening in a lot of countries. In the US, the stimulative policy may be somewhat offset by the higher tariffs, which could slow the economy, but perhaps help other economies. Bigger picture, though, geopolitical tensions can really lead to slower global growth because it leads to slower trade, it leads to less efficient capital allocation. And on top of that, investors are often a lot less willing to pay high multiples or high prices in the terms of bonds, i.e. lower yields, if the future is more uncertain. So I think the single biggest way that this will flow through to investment prices is through lower price to earnings multiples and potentially through higher interest rates as investors require more to be paid in order to compensate them for the risk that they're taking. So we think recent geopolitical activity could very well cap asset prices. So that's a lot to talk about. I think to summarize, things look fairly optimistic for many countries, but a lot of asset classes are starting off fairly expensive, and there's a lot of uncertainty out there. So we are still finding attractive investment opportunities, but we think it's especially important to be careful and analytical when investing as we head into 2026. So now we're going to move to some questions that have come in during the webcast. Again, if you'd like to ask a question, submit under the Q&A button at the bottom of your screen. These questions can only be seen by the panelists and not by other attendees. We'll get to as many questions as we can. And if we're unable to answer your question, please reach out to a member of your FLP to discuss the topic. So the first question that I wanted to go to is Fed independence and the recent Department of Justice subpoenas. What is your take on Trump's attempts to influence monetary policy at the Federal Reserve / what happens if the Fed becomes politicized? So Ryan, do you want to take that one?
Yeah, sure. Happy to. I think it's overall it's a bit concerning. I think for now it's a result of President Trump and the administration being laser focused on really trying to juice the economy and really trying to drive and accelerate economic growth. But to the question's point, where that could end up is not a good place, right? So basically, the reason why the Fed is independent is to avoid the ability to manipulate interest rates for short-term gain and thus paying a longer term penalty, which could come via inflation or interest rate stability. So, long term, heading down the path of a political Fed could be higher borrowing rates, less foreign demand for treasuries, a loss of safe haven status. But I think we're pretty far away from that. But for now, it's something we're watching closely.
I would add to that loss of Fed independence would probably be weaker for the US dollar because you would see capital leave, especially the US Treasury market. And we have been seeing that for the last few years, and potentially leave US markets of other types too. So I think that international diversification, both within equities and in fixed income, would be one thing that we would expect to see if there's more evidence that the Federal Reserve is beginning to lose independence. So another question that we have here, what are the market implications of sustained low job creation? Will there be reduction in aggregate demand? Where will that show up in valuations? What are the chances for political unrest? Well, I think political unrest is difficult to predict. I'll leave that to the political scientists. In terms of sustained low job creation, I'll take a stab at that. And then, Stephen, maybe you can jump in as well. I think if we have sustained low job creation, all else equal, the economy grows more slowly. I would distinguish, though, between sustained low job creation because of less supply, in other words, fewer immigrants, versus sustained low job creation because of artificial intelligence. I believe that artificial intelligence is not yet having a material impact on the labor market. It is having an impact in some areas, but it's modest and it will no doubt get bigger, but I don't think it's there yet. And I think this has been said many times by many people, but if you look at historical technological transition times and innovations, some people lose jobs in the short term. They may or may not be able to retrain, but other people step in and are able to have new jobs that didn't even exist when the new technology came into being. So there's no question that innovation can be disruptive, but it's also true. I mean, think about search engine optimization. That was a job for a long time, and that didn't exist when I graduated from college, that's for sure. So there are a lot of things that new technology enables, but the transition can be disruptive and it can be rough. Stephen, do you have thoughts on the impact on the job market?
I do. Terrific observations in terms of the artificial intelligence implications. I would also tie this back to the prior question in that the labor market is one of the key inputs for the Federal Reserve. And so it really highlights low job creation if it's sustained or even deteriorates further. It really highlights the challenge of questions around the Fed's independence. The assault on the Fed's independence makes it actually harder for them to take action in a weakened labor market. Right now, they're trying to balance inflation, which remains above their target, and a softening labor market. If that persists for a long period of time, the pressure, the political pressure being applied to the Fed, I think actually makes it harder for them to take action to support the job market if necessary, whether that's necessary because of AI or some other reason. The disruption could make the Fed's response more complicated, both politically and in terms of the economic implications. But ultimately, this is a consumer economy, and the single biggest factor in terms of what households are willing to spend is their confidence in the wages that they can earn. And so I think the question to some extent answers itself in that absolutely lower job creation is overall likely to impact aggregate demand negatively and suppress what would otherwise be a stronger rate of economic growth. I think the situation with the Federal Reserve just compounds that to some extent. And the implications for corporate profits are a little bit more mixed, as you could have a combination of fatter profit margins thanks to AI and potential layoffs with lower aggregate demand and much less clear what the equity market implications are, even if it's more clearly a negative for the dollar and the Federal Reserve overall, I guess.
Thanks, Stephen. A couple other questions on different asset classes. There's a question on commodities. Do you have an opinion on commodities, e.g., silver and gold? So I'll take that one first, and then I'll ask if anyone else wants to add to it. I think that in general, silver and gold act and have acted recently as alternative currencies. And so as we've seen the dollar weaken, there's been increased demand for gold. Part of that is because after we froze Russian central bank assets after they invaded Ukraine, it was a signal to the rest of the world that, in fact, central bank assets invested in treasuries were maybe not as safe as was believed before. And so you've seen a significant increase in central bank purchases of gold since then, again, as an alternative currency. Silver, similarly, of course, silver also has commercial industrial uses, but most of the movement that most of the price movement that we've seen, we think, is more related to its position as a currency rather than the supply and demand of the industrial uses. Sometimes people ask about gold stocks or silver stocks, and I would say that if owning commodities, which is relevant in a weakening currency environment, I would personally rather own the commodity than the miner, just because a lot of times the miners can be very cyclical. They don't always generate free cash flow. They don't always have good return on equity or return on invested capital. So in general, I'd rather just own the physical commodity than the miners or the equities that are exposed to that. But another way to think about it is not just an alternative currency to the dollar, but just an alternative currency in period. If you believe that all fiat currencies are going to depreciate, in other words, you believe in inflation, right? That's another way to think about it. Then commodities can have a role. And that's something that we're carefully assessing. I think that because commodities don't pay a dividend or a coupon, you're really purely betting that somebody else will buy it from you at a higher price in the future. And that's not typically the way we invest client money. But in a case like this, where fiat currencies are seeing higher inflation and may devalue, it could be something to look at. So Ryan or William or Stephen, do you have anything you want to add to the commodity question?
Yeah, just very quick for the commodity questions, and the gold, as Adam pointed out, is really driven by the depreciation of the US dollars and also the escalating geopolitical risk, and all the other central banks to see the frozen asset in Russia. And so the government like China and even the UK and now like Norway, and they all try to get the physical gold rather than the US dollars debt. That's to diversify and reduce the risk exposure. And so that is for gold. And for silver, and even to a certain extent for the copper, it's more complex. It's not just the dollar depreciation, it's all surging demand from AI and EV. And a lot of EV, the industrial usage, it actually began to use silver and as the application that can significantly improve the EV performance, electric vehicle performance, and also copper, as we all know, the AI data center build up and also the grid upgrade, they all use tons of the copper. So those are the more combination of the US dollar weakness and the AI and the EV demand driven. So industrial usage is surging. So those are the supply and the demand because the supply is kind of limited. It takes a couple years, several years to really expand the capacity for the gold, copper, silver. This all take years and a huge capex to increase the output. But demand, when the demand is all of a sudden surging as of last year and the potential 2026 keep going. So those will put the tailwind for those commodity, at least for 2026. But in longer term, as Alan's point out, those commodities don't generate free cash flow. And there's a very difficult way to even evaluate what's the real value eventually will be. It's really driven by supply and the demand. So right now, the situation is limited supply, but surging demand. So that push up a price. But longer term is tough to predict. That's my take on that.
I would perhaps also just tie this in with a broader question. I would also note terrific questions pouring in, and we're not going to get to half of them. So sorry about that. We'll get to as many as we can. But I want to tie this into a broader asset class conversation, which is real assets in general. Real estate's been through a difficult downturn disrupted by interest rates. And we're not expecting short-term interest rates to drop to an extent where we'll suddenly see a resurgence and dramatically higher commercial real estate prices. I think Ryan's described the internet interest rate outlook very thoroughly. But the environment is clearly improving on the commercial real estate side. Our alternative investment research team has been observing higher rate of turnover and the overall fundamentals, given, again, a soft labor market, modestly reducing short-term interest rates, and still a pretty stable and possibly accelerating overall economic backdrop, tell us that we appear to be through the worst of the commercial real estate cycle, and recovery appears to be ahead, but not likely a sort of snapback where we see valuations jump back to where they were immediately. Rather, stable valuations, maybe modest improvement, but at least generating the income that we're all used to seeing in the commercial real estate market as we go forward.
Thanks, Stephen. So looking at other questions, I think this one might be for William, but actually I think it's for all of us. What happens to markets if China invades Taiwan? William, do you want to start and then maybe pass it on?
Sure. I will get started. And so, great question. So that is a rising possibility for China invade Taiwan. So China, and especially after Japan, the Prime Minister announced that when China invade Taiwan, Japan will act. So China, in response, initiated another largest military practice in Taiwan, surrounding Taiwan. So tension definitely is going up, but in my view, it will very little opportunity. China will even invade Taiwan in the next 3 to 5 years. A couple of reasons. First, I'm watching that situation very closely, and interesting thing that Chinese President Xi, he just arrested a couple of very high-ranking military officers within China. So he is still initiate anti-corruption, these campaigns to try to really hold tight on the military. And so I think for the Chinese Liberate Army is not ready, and especially when the top military high-ranking officers is arrested, So they'll take at least 1 or 2 years to settle down with new people coming, make a new desire. And so that's the one thing. And the second thing is I don't think China really want Taiwan come back, but don't want to destroy Taiwan's economy. So number one choice is still the peace talk and reach agreement, just like how China get Hong Kong and Macau back, rather than use the military. So military is kind of like a threat, but the ultimate choice will be peaceful talk. So I don't think that a military action will be taken within 3 to 5 years. Longer term, it really depends on the global economy and the geopolitical risk. But the near term or mid term, I don't see that happen. And the impact, I think, even with that little chance, if that even happen, so there is a global ripple impact. We all know Taiwan Semiconductors, that's the only one monopoly can manufacture those high performing AI chips. And if Taiwan Semiconductor gets shut down, and also the facility in Arizona is not ready yet. So it will have a global impact on semiconductor, AI, and all those will be in the significant shortage. So that will be the standard market, global market, standard global market sell off. So that will be direct impact for that. And for other impact, I would like my colleagues to join.
I can
I think we have, sorry, go ahead.
I can speak to the fixed income implications quickly. I just think it would lead to a large sell-off in U.S. Treasuries, which would lead to higher rates as China potentially liquidates their holdings. So you'd get quite a bit of bond market instability, which would be very, very disruptive for the economy and credit markets and issuers trying to borrow. So certainly something we hope doesn't come to pass.
All right. Well, we didn't get to all the questions. Thank you, everybody, for putting them in. Again, thanks for your time. Please fill out the survey. And remember, it's anonymous. So if you want someone to reach out to you about a question that didn't get answered or something else, you have to put your name and contact information in there. Please read our newsletter, recently out on our website under the Insights tab. And we're planning more webinars this year. We'd love to see you there. Have a great night.
Thank you.